Welcome to this week's live episode of Bonkers.ie TV, where we're all about smarter money and keeping you updated on everything that's happening in the world of personal finance and consumer affairs. I'm Dara, and this week we're going to talk to you about the central bank's rules for mortgage lending. So the central bank's rules for mortgage lending were introduced back in 2005 or 2015, at this stage, and they fundamentally changed how the mortgage application process works. So for this video, we're going to go through what those two rules are, how you can get an exemption to the rules, and what it will mean for first-time buyers, movers and switchers. So first of all, let's have a look at what those rules are. So there's two rules. So the first rule is the loan to income rule. And basically, this rule states that you can only borrow up to 3.5 times your income. And this rule applies regardless of how much you earn. So even if you only earn a small amount of money or a large amount of money each year, according to the central bank, you can only borrow 3.5 times your income. So let's say, for example, that you were earning €50,000 a year under the central bank's rule, you'd only be allowed to borrow €175,000. Now, if you are in a couple and there's two of you and it's a joint application, then that number doubles. So if both of you are earning €50,000, you'd then be allowed to borrow €350,000. The next rule that you need to look out for is the loan to value ratio. And basically this rule dictates how much you're allowed to borrow in relation to the value of the property, or in other words, how much of a deposit you need. So according to the rules, if you're a first-time buyer, you need a deposit of 10%, and if you are a mover, though, you need a deposit of 20%. So let's say, for example, you were buying a house that was worth €200,000. According to the central bank rules, you'd need a minimum deposit of €20,000 if you were a first-time buyer and €40,000 if you are a mover. So it's not an insignificant amount. Previously, banks could give out mortgages up to maybe 95% or even 100% of the property's value, but that has now changed. So they're the two main rules. So it's the loan to income rule, which applies to first-time buyers and movers, which is 3.5 times your income, and then the loan to value ratio, which is 90% for first-time buyers, or a 10% deposit, and a 20% deposit for movers. Now, as with everything in life, I suppose there are some exceptions to the rules, and sometimes these are called exemptions. And the first exception is to the loan to income ratio. So in some cases, the banks can actually lend more than 3.5 times your income. It depends on how, I suppose, good your application is, but sometimes the bank will actually lend up to maybe 4 or 4.5 times your income. And the way the exemptions work is that the bank, if you are a first-time buyer, 20% of the mortgages that the bank gives out can breach the loan-to-income ratio. So for 20% of mortgages to first-time buyers, the bank can loan you maybe 4 or 4.5 times your income. Now, if you are a mover, it's slightly different. In this instance, only 10% of the mover mortgages are allowed to breach the income limit. So I guess for some people who maybe feel that they don't earn enough to be able to get a house at 3.5 times their income, this limit can be, or this exemption can be important, as it means that you're allowed to borrow more than 3.5 times your income. Now, for the next rule, the loan to value ratio, it's a little bit different. In this case, 5% of mortgages for first-time buyers are allowed breach the limit. So if you were buying a house, let's say, using our previous example, for €200,000, instead of needing a 10% deposit or €20,000, you'd only need a 5% deposit or €10,000. And if you are a mover, where you need a 20% deposit usually, in 20% of cases, the bank is allowed to breach that limit. So there are some exemptions that people can access, which can help make buying a house a little bit easier. So I guess the next question is, how do I get an exemption? How do I get around the central bank rules? So really, there's a few things to consider. The first thing is that obviously there are limits. So like I've said, for, let's say, first-time buyers, only 20% of mortgages can breach the loan-to-value limit. And what tends to happen is a lot of those numbers and a lot of those exemptions or exceptions get used up very, very early on in the year, because the banks will be fined if they fall foul of the rules. So the banks are really, really careful and really, really eager to make sure that they don't fall foul of the rules. And what tends to happen is that all of their exemptions get used up, usually within at least the first half of the year. So if you're hoping to get either a loan to value or a loan to income exemption, it's a really, really good idea to get your mortgage application in now so that you'll get the mortgage approval in Q1 of 2019. Also, people who have a good quality application are usually more likely to get given a mortgage exemption, and also people who earn more tend to get a mortgage exemption than people who don't. So the usual minimum amount that's required for an exemption under the loan to income rule is €50,000 if you're a single applicant and €75,000 if you are a joint applicant. That might seem a little bit unfair or a little bit kind of contradictory, as you might think, people who are earning less are the people who need the loan to the loan to income breach more. But unfortunately, the banks don't see it quite that way. And the more you earn, the higher your salary, the more likely it is that the bank will lend you maybe 4 or 4.5 times your income. So if you are looking for an exemption, apply early. Make sure that you have a good quality application. So, obviously you in a strong employment, have been in a job maybe for at least a year, no missed loan repayments or anything like that. And then also, depending on how much you earn, usually the more you earn, the more likely you are to get that exemption. Now finally, just look for switchers. So a question we often get asked is, do these rules apply to switchers? And the answer is no. So there's nothing in the central bank's lending rules that states that switchers need to abide by a loan to income limit or a loan to value ratio. Having said that though, if you are looking at switching your mortgage, and at Bonkers.ie we're always encouraging people to switch, particularly in relation to your mortgage, because you can save so much. If you are looking to switch though, the bank will have their own rules that they'll use to assess your application, and it's not guaranteed that they'll allow you to switch. And particularly if you are in negative equity, it's highly unlikely that you'll be able to switch. And usually for switching, you'll need to have at least 10% equity, or the equivalent of a 10% deposit if you're looking to switch. So whilst the central bank won't have rules around switchers, the banks themselves usually do. So that's it in relation to the mortgage lending rules. So just to recap, it's 3.5 times your income for a first-time buyer and a mover. And you'll also need a 10% deposit if you're a first-time buyer and a 20% deposit if you're a mover. However, there are some exemptions or exceptions that can be given out by the banks, and these usually get used up at the very start of the year, or at least in the first half. So if you're hoping to get one, now is the time to think about doing it and pulling in your mortgage application. So hope you find the video interesting. If you want any more information on the central bank's lending rules, just head over to our blog. And if you want to get in contact with us, feel free to comment in the box below or catch us on social media. So thanks for watching, and see you again soon.